Hi there, I'm Matthew Wiseman, Director and Mortgage Advisor at The Money Hub. Today I'm doing a quick video about shared ownership mortgages. Now we get a lot of inquiries in this area, so I thought I'd do a video just detailing what these type of mortgages are, common questions that people have, and how you go about arranging one. So first of all, what is a shared ownership mortgage? So this is when you want to buy a share of a property. So let's say, for example, the property is worth £100,000. You may want to buy 40% of the property, which would be £40,000, and the remaining 60% of the property you then pay rent on, typically to like a housing association. So why buy a shared ownership property? So a lot of people would like to get onto the housing ladder, but unfortunately they're unable to buy a property outright due to not being able to borrow the full amount required, or maybe not having a big enough deposit. So if you therefore buy a share of a property through a shared ownership scheme, the borrowing requirements will be less, and also the requirements to have a big deposit will be reduced as well, because you're only buying the share of the property. So shared ownership mortgages are available with most high street banks and building societies. However, they will have a different criteria that they work towards. So for example, some lenders may require a 5% deposit for you to put down, while other lenders may require a 20% deposit. There are also specialist lenders that can help clients, which are available via mortgage brokers. And this is to help clients that have maybe got sort of complex income structures, or maybe have a low credit score or bad credit against themselves. So a common question that we get is, can you get a mortgage if you've had bad credit in the past? There are lenders that are willing to help clients. Many questions will be asked. So for example, this bad credit, when was it registered? Was it missed payments? Was it defaults? Or was it county court judgments? Or did it go further than that? Have you since satisfied this bad credit? So a lot of information is required. It's very much you want to speak to a specialist mortgage broker in this area that has got experience. But generally, there are lenders that are willing to help clients. So how much can I borrow? Now, lenders typically lend 4 to 4.5 times your income. However, there are many other factors that need to be considered. So for example, how long are you looking to take this mortgage for? In relation to your income. Now, if you get a basic salary with lots of overtime and commission, lenders may not use 100% of this overtime and commission. If you've got any loans or credit cards, these will have to be factored in as well in relation to your long-term affordability. Plus, once the mortgage is in place, will you be paying out on other things? For example, on a shared ownership property, you'll be paying out the rental aspect as well. Plus you may have a service charge that will be paying out for as well. So very much a detailed income and expenditure needs to be completed with a client, and then the broker and the client can work out exactly how much they can afford to borrow, and certainly what is affordable. So when it comes to organise a mortgage, there will be fees that are payable at different parts of the transaction. There will be a valuation fee payable. Now this is due up front. The amount of this will depend upon the actual property value. Lenders do charge arrangement fees. Now these can be flat fees, or they can be a percentage of the amount you want to borrow. There will be solicitors fees as well, and they could be due, some of it could be due up front and some of it on completion. Plus a solicitor could advise you if stamp duty would be payable at all. Plus there will generally be a broker fee as well, and again that could be payable at different stages of the transaction. So what you want to do is get a nice clear illustration from the broker detailing all the associated costs which are involved. So apart from paying the mortgage every month, there may be ongoing costs which you need to certainly factor into your affordability. So for example, on a shared ownership mortgage, there will be the rental aspect of the property, plus there may well be a service charge payable as well. But there may well be some insurance products that should be considered, such as home insurance, life insurance, serious illness insurance. You should consider all these type of policies. I'm sure the advisor will talk you through these, so you're very clear. And once you take this property and you buy the property, you know exactly what your cost and ongoing affordability will be like. Now, with a shared ownership mortgage, you do generally have the option to buy more shares within the property at a later date. Now, the benefits of doing this is the more shares you own in the property, if the property value goes up, you therefore benefit from that. And again, if you own more shares in the property, the rental aspect or the rental payments that you're making will reduce. So how do you go about arranging a shared ownership mortgage? So the first thing I would do is go get a copy of your credit report. Now lenders will look at Experian and Equifax to get an idea of what your payment conduct and credit profile is like. There's a company called Check My File that shows credit reports from both these agencies. That certainly would be a good start. From there, I would speak to a mortgage advisor such as myself. Now I would go for a fact find with yourself and also confirm your sort of income and expenditure. I can then research the market and give you an idea of what options would be available. Now, if you're happy, we could then proceed and get an agreement in principle done with the lender. And this would therefore provide you with a full detailed illustration of all the associated costs, etc. Now, from that point, if you've got an agreement in principle, you can be confident you can start looking at properties and put an offer in place. Now, if your offer is accepted, we can therefore start the mortgage application process. Now, throughout this process, there will be many documents that will be required from yourself. Starting off with proof of identity. So we would need a copy of your passport and also of your driving license. So make sure these documents are in date and the address is correct. Secondly, we'd need 3 months bank statements. So this would be to confirm what your outgoings are and also what your sort of conduct is like as well. And finally, proof of income. So if you're employed, we would need 3 months pay slips and your P60. And if you're self-employed, we would need your tax calculations and tax overviews or your accounts. Now, the lenders always reserve the right to ask for more information at a later date. Well, I'm Matthew Wiseman, Director and Mortgage Advisor at The Money Hub. Hopefully you found this video helpful. If you want any further information, please give me a call or you can drop me an email and it'll be a pleasure to help you. Thanks a lot.